Howdy there, folks. Welcome into this buy one, get three free here today in this one. 4 videos up here for me to react to. First one up here is this 3-minute clip. The stock rally likely went too far, too fast in November. Victoria Green, want to hear what she has to say in regards to that one, react to that one, kind of share my opinions. And this gentleman from Goldman Sachs says the stock market has modest upside in 2024. So a lot of people are starting to do their 2024 predictions now at this point in time, now that we're up upon the end of 2023, right? Then we're going to react to this one, which I thought was interesting. The Fed has basically become a giant hedge fund. So I thought this is from a former World Bank president. So I thought this was a very interesting subject. I'm looking forward to watching that one, reacting to that one, and this one. And the last one up here, investors shouldn't expect a repeat of 2023 in the stock market next year, says this individual from JP Morgan. So appreciate y'all joining me as always. Thanks so much for being here. Thank you for smashing that like button. Appreciate each and every one of you. Thanks for being subscribed to the channel. If you're looking to apply, join my private group. Check out the pinned comment down there, fill out an application. We can see if we can get you in there this week. Access to all my courses, Discord chat, all that good stuff. All right, guys, let's get into this.
Now, following the S&P closing down 0.5% yesterday, breaking a weeks-long rally in the markets. How do you see the market shaping up today? What's your WEX word of the day?
My WEX word of the day is pitch, and it's such a variable word, but I mean pitch in aviation. There are 3 axes for aviation. You have roll, you have yaw left to right, and pitch is the nodding up and down of the nose of the airplane. And I'm a little concerned we're going to be nodding down, and this isn't a great pitch right now of the markets, because that's what everybody's trying to figure out. Are we going to continue to nod up or nod down? So I think the pitch is a little at risk today for a nod down.
All right, so you think the pitch is a little bit at risk. Give us a sense. What's creating this risk? We were talking earlier today about some investors maybe thinking that their confidence that the Fed was definitely going to cut rates has been shaken a little bit right now. What are you looking at when it comes to the markets? I know you're looking at the JOLTS coming out later today. Yeah. What do you think that's going to tell you?
It should be continue to go down, right? We need to see JOLTS continue to go down. We need to see labor force continue to shrink and get pressure, because that's the hope. You're pricing in now March. The cuts keep getting brought further and further forward in 2024. And that's what I think is putting people at pause. How aggressive is this rate cutting going to be next year? And I think a little bit too much is getting priced in right now, which means this rally may have gone a little too far. So if you don't see JOLTS continue to contract and you see employment continuing to remain strong, why is the Fed going to cut in March? And I think investors need to step back and really ask that. Why is the Fed going to be cutting? They're only going to cut if employment's come under pressure, or 100%. We see inflation get to the point we're in a deflationary environment and they really need to look to stimulate. They're not going to stimulate just to support the stock market.
100%.
They really don't care what the stock market's doing unless there's a liquidity crisis.
100%.
You know, Joe's coming out not too long after.
100%. She's right on. Now, do I feel the stock market has gone too far, too fast? And the answer to that is, in regards to big tech, maybe a little bit. Maybe a little bit. Okay, the Apples and Microsofts, those sorts of stocks, maybe I feel like we have gone too far, too fast. Have we gone too far, too fast with dividend stocks, safety stocks, small caps? Absolutely not. No. Those ones have a long way to run. But again, some of those big dogs, I feel like they probably have run a little too much. Their valuations are way too stretched considering their growth rates. And yeah, I feel like if anything, there's weakness in those ones, whether it be later this month or whether it be just in the first quarter of the year when a lot of people are maybe looking to take some profits in some of those big dogs. Because not everybody wants to take profits right now. You got to pay tax this year if you take profits in those big dogs, right?
Hour after the opening bell. So you mentioned that we need to see continued decline. The estimate for this month, 9.4 million. Last month's actual was 9.6 million. So is it simply that same level of decline that we need to see, or does it need to be even deeper?
I think you're going to need deeper. We're seeing this still. The labor market has to continue to tighten, and it's hard for it to tighten if you have 9.3 million job openings and you almost have a 2-to-1 ratio of jobs per person looking for jobs. Without the labor market tightening, without unemployment coming up, I don't see the pressure on the Fed to do these.
So when do you have to worry about job openings? The number is under 6 million. If we go under 6 million with job openings, that's, batting up the hatches, kind of worry time. Now, prior to the great financial crisis, we were at about 4 to 5 million job openings. So, but yeah, if we go under 6, I think that would be a number to kind of like, woo, getting a little scary.
So cuts that are priced in. And if suddenly we don't get some of these March, April, May cuts next year, you're going to see a little bit of repricing in the markets. And I think we just ran a little too far, too fast. Everybody got excited about Fed rate cuts next year. And now we maybe have moved to the point we're a little aggressive on what we're thinking they're going to do to ease and support this market.
I want to turn back to the pre-market for a second. Look at the NASDAQ futures, down 0.5%, the hardest hit of all three indices. You're looking ahead to earnings later today, MongoDB, part of that big AI trade. What are you expecting from this report, and how influential do you think it's going to be, not only to NASDAQ, but just to tech in general?
Yeah, and it's been interesting, right? The mega caps kind of rolling off this week and not being able to be market leadership in the broad market rallying. MongoDB, I'm looking for a beat. They beat on adjusted EPS 12 out of 12 quarters. A beat is something that isn't going to satisfy the market. It's got to be a beat and a raise. You see that with these high-priced tech stocks. It's not just about what you did for me last quarter. It's so much more about what are you going to do for me going forward to justify the multiples you're trading at. We did see Datadog do well, so I am bullish. I think they're going to beat 500,000 plus on earnings. EPS at 51 cents. Those are a little bit of a low bar considering what they did last quarter. As long as they've seen continued sales growth, then they should be good. But again, it's going to be what that outlook looks like that moves the stock.
Yeah, so the stock I'm looking most forward to that's reporting after the bell today, and I will be live streaming this company's earnings today on Twitch. So if you want to join me for that, check out the other pinned comment down there. I'll have the application for the private group and my Twitch if you want to join me on Twitch. It's free to join me on Twitch. But the stock I'm looking most forward to that's reporting after the bell today is Toll Brothers. Toll Brothers. Really want to hear what they have to say, want to see what those numbers are. That should be very, very interesting after the bell. So looking really, really forward to that one. All right, next one up here. Stock market has modest upside in 2024.
Ahead, Goldman Sachs chief U.S. equity strategist David Kostin. He's got an S&P target of 4,700 next year, David. So it's not a ton of upside, but I like how you use Taylor Swift lyrics for all your notes. All you have to do is stay. That's what you do in the market?
Well, I think it's a good way of thinking about it. The baseline forecast is modest upside because valuations are pretty high. Earnings are going to grow roughly 5%. But there's a tail scenario, which is if rates stay low, and rates have dropped really significantly. Real 10-year bond yields were 2.5% at the end of October. They're now roughly 2%. It's a very significant decline in a short period of time. Stocks rallied 10%. Roughly in the last month. And so to the extent that rates continue to fall or stay at low levels, that could support an S&P 500 level close to 5,000.
Unless they're falling because people are worried about recession, though, right?
Absolutely. The question is, what's the reason? They're falling because inflation's coming down, or are they falling because the economy is weakening? And right now, we'd put the argument on the table that inflation has been coming down, will continue to fall, and that's a positive story about why rates are falling. And that's, I'd say, largely a topic that's debated among the portfolio managers with whom I interact.
Wow,
5% earnings growth next year. Do we get revenue growth, though, in an environment where you see inflation continuing to fall?
So all that earnings growth is stemming from revenue growth. Most companies will generate revenue growth of around 5% because that's nominal GDP growth. Real GDP growth around 2%. Inflation is coming down, but it'll probably average close to 3% next year. So 2 plus 3 is 5. Most companies will show top-line revenue growth around 5%. And it's not going to be a margin expansion story. So to answer your question, it's really a sales story, which is pretty positive, not extraordinary, but a modest level of increase in profits. And valuation is a real challenge, and it's a challenge on the upside if you were to have a story for higher valuation.
Sealed Air, the reason that stock's down pretty significantly today is they're getting kicked out of the S&P 500. And in their place, do you know who's getting put in their place? From what I heard, it's a company named Oobity Booba. Oobity Booba stock is replacing them in the S&P.
Really require bond yields to fall. And they're already at a pretty low level. And our assumption is that real 10-year bond yields will be closer to 2.25% at the end of next year, a little bit higher than we are now. And that supports our 4,700 targets, a baseline forecast. As I said, there's a scenario where you could have market rise even more, closer to 5,000 if you had rates continue to fall.
You recently published your hedge fund trend monitor and mutual.
So 4,700 S&P next year. How do I feel about that? Do I think that's realistic? Do I think that's too low? The answer is I think I could see that happening. I think that's definitely a possibility. The Apples and the Microsofts, some of those biggest big dogs, I just don't think they're going to have a roaring year next year like they had this year. And if they have a very timid year where their stocks hardly go up or maybe even potentially go down a little bit, that's going to put the markets in a situation essentially where it's not going to have some banger year when it comes to S&P 500 or when it even comes to the Qs for that matter, because those are such big weights in those indexes in general. So I think that's realistic. I think it's definitely a realistic possibility.
Fundamentals report. You talk to, the $5 trillion of hedge fund and mutual fund.
Costco over $600 a share now. Holy smokers, that's no jokers.
The hedge funds and mutual fund managers who represent roughly $5 trillion. What did you find?
Well, there's a couple things that were interesting. One is the whole debate takes place around the big 7 stocks, and the hedge funds have tended to be overweight these.
What did I tell you guys in regards to PayPal? Like, I worried about some tax loss harvesting in December. Like, I've worried about that, right? Worry is a weird word to use, but I've thought about that, and I've talked to you guys about that many times. Like, PayPal, going to be some tax loss harvesting in December.
Magnificent Seven, as the sobriquet has come to call them. So that's sort of one big observation. The second is a huge continued concentration that the top 10 positions comprise roughly 70% of the long positions of the typical hedge fund. And that's persistent across all the funds. So that's been rising, David, over time. And that's another area that does create some risk in terms of performance that these stocks, major stocks, continue to be the leading the holders. On the other hand, mutual funds tend to be underweight these positions, and that's led to a notable underperformance relative to their benchmarks. Core managers, growth managers, only about 20%, 25% of them are actually beating the benchmark, and that's largely been an issue around the positioning around these stocks.
That is not pretty when you have only 31% of large mutual funds kind of meeting their benchmarks.
I just want to say here in Vegas today, man, it is warm. I mean, like, that sun is beating on me. I mean, for December 5th today, whew, I don't even need this hoodie on. I'll be honest, I could be out here in a T-shirt and be just fine today. Holy smokes.
What about this market dynamic that we talk about so often? We mentioned even today things have turned and we focus on the Magnificent Seven. Do you expect it to continue? And how are investors supposed to adjust?
So here's what we did that was original in our research, in my opinion. Is rather than think about the valuation for the index overall, we focused on fair value for the equal weighted index. What is the typical stock? How should the typical stock be valued? That's part one. And while the index trades at 18 to 19 times in an aggregate context, obviously skewed by some of the biggest stocks, the median stock, or the typical stock, equal weighted, is around 14, 15 times. That is in line, David, with the average for the last 30 years. So the typical stock is sort of averagely valued over the last several decades. That's sort of part one. And the second part is, well, what kind of premium should the aggregate index trade relative to the equal weighted index? That's an important dynamic as well. So the average stock, typical stock, is trading fair value. And right now, the aggregate index is around a 27% premium. Put that arithmetic again, 14 times, roughly 18 times, that's a 27% premium. And that's also fair value in the context of the risk metrics that we look at. And so the message we have is the typical stock is fairly valued. And the larger stocks are around the premium that they ought to be trading. And those are looking at risks, metrics around risk premium on interest rates, inflation, et cetera.
That's interesting. Yeah, I mean, if you look and you really want to know where are the undervalued stocks in this market, the truth is the undervalued stocks are the smalls and the mid caps, right? You look at the forward Ps, I mean, those are trading, and have been for about 2 years now, have been trading among the lowest forward Ps we've really seen them at in decades, to be honest, over the past 25 years or so. So that's where the biggest opportunities are out there. But, they've been trading very low for 2 years, right? And at some point in time, they're going to catch a bid and they're going to fly to the moon. And some of them have already started to fly to the moon, let's just be honest. I mean, a lot of those stocks are up 100% plus in the past either month or the past 6 months or situations like that, right? All right, next one up here. The Fed has basically become a giant hedge fund. This seems interesting.
David Malpass addresses how he thinks the Fed can boost economic growth. He says it comes down to 4 things. Here they are. The central bank must shrink its balance sheet, stabilize the dollar, get capital flowing, and speak out about fiscal profligacy instead of totally greasing the skids and enabling fiscal profligacy, which some people would say that's what we've seen in the last 10 years.
Oh, my gosh.
Yeah, it's worrisome. The Fed basically has become now just a giant hedge fund. It's lost $1 trillion, and counting. It's going to be a gigantic loss. What it does is borrows money at 5.4% from banks and then dumps it into government bonds. So think what that trade does. That causes the government to think that it's better off than it is. And so that encouraged the government to be short when rates were zero. So why did the government borrow so much in T-bills? Well, because the Fed was buying the bonds and it made it look like yields were going to stay low for remember the low for long phrase. So we've got these multiple problems that are going on, and it endangers the dollar. So that's the basic case.
Fair.
Instead of the Fed having such large balances, wouldn't the private sector be starting businesses and risking capital and bringing returns and adding to growth? Wouldn't all that money be better if it wasn't with the Fed?
That's right. And we're depending on private equity. So as the banks get squeezed out, because they're lending so much to the Fed, it's literally a floating rate loan from banks to the Federal Reserve so it can buy government bonds. So if that were freed up, that would allow the banks to at least consider a small business loan, an inventory loan, the kinds of things that help the economy grow. And this is on a global basis. It's not just the Fed. It's all the major central banks doing the same thing, meaning taking money from the economy in order to buy government bonds. We need to be clear on that. I heard the previous segment, they talk about money printing. There isn't any money printing on it. It's just money borrowing, and they pay top dollar for it. The Fed pays 5.4 to banks and 5.3 to money market funds, so to the Fidelity and Vanguard and so on.
You think that the Fed has a big role in helping us with growth, and that's the only way out of this mess?
It shouldn't have it shouldn't try not to do harm, and that means to allocate capital to government is going to slow global growth. So we have this problem facing the world of growth forecasts going down into 2024. The population is going up. The fragility of the world is getting worse, as we see all over the world. Fair. Refugee flows are increasing, and that comes back to that the world should be making enough capital, enough profits in order to grow the global economy, and it's just not doing it, in part because so much of it is going to government. A big problem is the government always gets first dibs on every dollar that anybody earns. If they want...
Okay, I gotta say this. I've gotta say this. I like this guy. It's not that often I ever watch somebody and I'm feel like I'm actively learning a lot. I'm watching this and I feel like I'm learning a lot from this gentleman, and the way his perspective is on this and the way he's describing things much different than most folks would ever describe it. So I'm loving this segment right here.
Borrow it. They're the lowest cost borrower in the whole world. So if the U.S. government wants to borrow $60 trillion, the world will step up and say, where's my chance? And that is really harmful to the business climate because you're altering the risk-return ratios.
You say a lot of similar things to Judy Shelton when she comes on. Do you familiar with her take on things?
Oh, I know her, and so
how do you differ?
Oh, well, she's talked about the gold standard. I think we need to use gold as one thing to look at for the Fed to see when it's maybe off track. But
just in terms of the
interest rates,
being the fiscal and authorities and the Fed being attached at the hip.
Yep. So the Fed is way too big. It's also, we haven't talked about, but the regulatory policy aspect of the Fed is dominant. It didn't used to be that the Fed was the major regulator. There were bank regulators, but now the Fed is the dominant bank regulator. So they're basically doing two things. They're deciding how much to pay banks and then how to regulate banks at the same time.
Wow.
And so that's really a conflict of interest and so I think the answer is one of compromise. Just bring down the balance sheet a lot. There's no reason why the Fed needs to have such a giant balance sheet and make such a big bet on the government. It's not fair to the people to have the central bank making this giant, it got all the way up to $9 trillion. It's come down a little bit, but not fair to have an agency of the government making a bet on the government.
How would, I mean, if you abolish the central bank?
I didn't say abolish.
Do you need a Taylor rule? Do you need rules?
For one, you need some restraint by the Fed to recognize that it shouldn't be.
It's a different guy. It's a different guy or gal every couple of years. I mean, you would need some type of something written down that people have to follow, wouldn't you?
In general, I think the Fed and economists should agree that the central bank shouldn't be buying maturities beyond 3 months. You know, it's okay for the central bank to own treasury bills. They can borrow from banks and put it into treasury bills, and that's kind of an arbitrageable situation. But for them to decide whether to buy a 5-year or a 9-year bond off the run or a 10-year bond, how does the Fed know how to do that? So it's not an issue at all of abolishing the central bank. It's saying that they've gotten way too big and are being followed too much by all the financial markets. They shouldn't be in the middle of all this. I'm also concerned about the inverted yield curve. I mean, think of the oddity and the harm in finance of having a 5.5% Fed funds rate or policy rate and going all the way down into the long term. It helps the rich and it hurts people that want to borrow floating rate. So all the little guys around the world are, not just in the U.S., but worldwide, have to borrow at the short end, whereas wealthier people can borrow at the long end. And so it's just not a balanced situation. And as I argue in the Wall Street Journal article, easy enough, or not easy, but the Fed can engineer a course out of this simply by saying, look, we're going to defend the dollar by allowing some of our balance sheet to burn off. It's already doing that.
So I thought that was a great clip by this gentleman here. But the one thing I'll say is anything going to change? And the answer is no. So he made great points, but I don't see them changing anything. Okay, investors shouldn't expect a repeat of 2023 in the stock market next year. JP Morgan.
4-day win streak. Join us now. Mira Pandic, global market strategist at JP Morgan Asset Management. We had one of your technical guys on yesterday.
Oh yeah, we reacted to that.
Horrible. 3,500 was his prediction. You're not there, but you certainly think we've gotten a lot of next year's returns already in where the averages are right now. Because it's not going to be great next year in terms of earnings and in terms of other things. And we've already had huge gains. So valuations are high, I think you think.
The theme for next year is tempering expectations in 2024. I do think overall we have a pretty benign outlook for the economy itself, but when you've had a 20% rally this year, when you've had elevated valuations, and when earnings expectations for next year are in the double digits, when we can probably achieve something about half of that, just given what we heard in the third quarter from CEOs, gloomy outlook. Remember that disinflation helps markets and margins. It doesn't help revenues. So we worry a little bit on the revenue side as to what companies can produce. So if you put all of that together, we need to be a little bit less optimistic, I think, than many in the marketplace are right now about next year, especially because what we've seen in November is very much a sentiment rally, not a fundamentals rally. It's been driven. I
think the thing she misses about disinflation is what it means to the consumer and the pickup you can see in consumer spending if the consumer is stuck in a situation, put into a situation where their real wages are expanding quite dramatically, or the best it has in years. And that's what probably is coming in 2024. We'll likely see real wages get in the best place for an average person that we've seen in years. Like, real wages have been bad for years, and we're likely going to have a great year in 2024 when it comes to real wages of individuals out there.
High multiples. We've seen a collapse in bearishness if you look at the AAII investor sentiment survey. So I think people are getting a little bit exuberant about finally having some relief from the Fed, but we have to think about what that actually means next year.
24 was supposed to be the year where we return to double-digit growth. You're convinced with what we heard in the third quarter from the outlooks that these guys aren't just being conservative. You know, a lot of times they talk down expectations so they can beat expectations. You think we can now say with some probability that it's only single-digit earnings returns next year?
I think that's fair because also the big focus this year was margins, and we saw a lot of margin stability. But I do think at this point, the pricing power has been exhausted. Luckily, that comes at a time where we're seeing decelerated wage growth, decelerated input costs. But I do worry about when we pair this with some of the headwinds with the consumers, what does happen on the revenue side? I mean, if we look at the Atlanta Fed's GDP tracker, last quarter realized we had over 5% growth, but we're slowing to about 1.2%. So as the economy normalizes, as the consumer becomes a bit more judicious, as companies even say, maybe I need to cut prices a little bit to bring people in just to support those revenues, I'm not sure that double digits is realistic.
So we've had margin expansion, multiple expansion. You noted that already. There's no more of that coming, so we can just purely use your earnings per share number for what the stock market is likely to return. So you're talking about 5% for a stock market return?
I think that's a reasonable outlook for next year, again, with a pretty benign going back to normal type of economy for the economy itself next year. In 2024, we see a 2024 economy. So 2% growth, 0 recessions, 2% inflation and 4% unemployment. So again, a relatively benign outlook, but again, after such a strong year, it's just hard to see.
Why would anyone?
That's fair. That's fair.
Buy stocks rather than a 2-year. You can get 5%, close to it. So if you can get that risk-free, why?
Well, that goes into something very important. That gets into where are you positioning into the market. If you're just positioning in the S&P 500 and you think you can get 5%, I can understand. Buy a treasury, get 5%. Put a savings account, get almost 5%, right? Depending upon which financial institution it is. But if you look at something like small caps, could the Russell roll 10, 20, 30% next year? I think that's perfectly possible, even if the S&P 500 is blah next year. So it really depends on where you're positioned. Could some dividend stocks have some huge years next year? Yeah, I think there's going to be some dividend stocks next year that are up 30, 40, 50, 60, 70%. But it depends on where you're looking in the market, right? S&P 500 as a whole, I wouldn't be that bullish on it overall for next year. If it's a great year, great, but I wouldn't expect it to be a 10% plus type year for the S&P next year.
You can't guarantee me that the market's not going to be down 10% next year.
No, I can't. And I think having a little bit of balance is important because if any year were to be down 10%, coming into this year, we would have thought probably this one. We had expectations across the board for negative returns, and we got up 20. So I think we need to be prepared in portfolios for the upside risk. We always undersell what could potentially be upside risk. So we want to still hold on to those risk assets for that reason. But there's no reason not to have short duration fixed income 2-3 years out on the curve because you're getting good income. We don't quite know exactly what's going to happen next year. If we have more of a soft landing, that would actually advocate for shorter duration fixed income. We still want to own some duration because of months like November, where we have the best month since 1985 for the U.S. ag. That was what we were expecting at some point to see, not all in 1 month, but to see some sort of pullback in yields. We've seen that now. I think there's maybe a little bit limited scope for yields to come down that much from here. So having a mix of risk assets, if we have a benign economic outlook next year, and some shorter fixed income is
that's fair, and have some hedges as well. So a few hedges go a long way if done properly. Okay, it's going to wrap up today's video, folks. I got to get on Twitch. We got a bunch of earnings coming out after the bell, including Toll Brothers, which I'm looking really forward to. If you want to join me on there, check out the second pin comment down there. First pin comment down there will be application if you want to apply to join my private group. Other than that, folks, much love as always. Thanks for being subscribed, and have a great day.